Hey, and welcome back to the Heinz and Clark YouTube channel, not the podcast, because they're wickedly different. Somebody knows. But welcome back to our YouTube channel. We've got, I don't know, could be interesting, could be controversial, could be political, a little bit different take, different episode, different show. We are gonna very high level walk through, and I mean very high level, walk through the Trump tax returns. If you've heard, they Congress released them, and they've created quite the stir. And so we thought, well, hell, let's take a look at them. Let's see what we see and see what we can explain, what we can maybe say this makes sense, this doesn't make sense, and we want to be clear. And I think Steve's going to go into this. That we're making no claims on anything other than the information that is included on the returns. We haven't audited. We haven't reviewed. We don't have access. I don't think either of us reached out to Trump to see if we could get access.
He didn't answer when I did.
Okay, let's see. Fair enough. But we're just going based on the information that's there and just kind of talking through what we see and just giving some high-level information on it.
Yeah, and high level. So Aaron and I, there were 6 years that were released. We split it up. I did the first 3, he did the second 3. So from 2015 to 2017, I went through 1,786 pages of tax return. And that doesn't even include his actual business returns. It's just the K1s from
3,000.
Yeah, pages. So high level. But I think it's good enough to kind of paint a picture of kind of what's on there. And it's clear to us, obviously, and probably not. Some of this won't be new, I'm assuming, to a lot of people, on kind of some of the strategies that he uses or has used in the past as well. And I think we were talking about this morning, that I think at the end of this, you might get the impression that it's almost like we're defending him, if you will, on this. And I think, like Aaron said, it's really just the tax return, and I think too it's based on some of the strategies that we've seen. And as we were kind of talking too, most of the strategies that he's used, we have used somewhat ourselves, and even and a lot with some of our clients too. So, we were kind of saying, like, he's obviously very wealthy, but a lot of these strategies can be used by people who are maybe not quite that wealthy. But so I think there's a lot of strategies in here that can be utilized, maybe not to the dollar amounts, but in similar fashion too. So
yeah, just kind of on that. Yes, this is what we're maybe defending more than anything, is tax strategy and the ability to use the tools and the rules and the laws that are out there, not in defense of pretty much anything other than that, or not even in defense, explaining some of the tools and the rules that were used in what we can see from a high level on the returns.
Yeah. I think too, I will say, I really think that the vast majority of CPAs and tax preparers out there are not crooks, right? So, and I think it's, most preparers aren't going to knowingly put bad information on a tax return. And I think, as we were talking too, some of the strategies that he used requires the use of many other professionals, obviously attorneys. Some of these things, I'm assuming there were probably multiple attorneys working on. There were contractors, appraisers, probably multiple CPAs. So again, all professions that I have, typically have a high level of respect for. Obviously, there's probably some crooks in all those fields, but so I think it's just we're taking this at face value and kind of going with the assumption that the data on the return is accurate, what's been reported, and we're going to go on that. So again, a couple high-level things before we jump into some of the details on the years. He seemed to me to have like a pretty detailed accounting bookkeeping structure, if you will. There was a lot of information to report. One of the businesses on a Schedule C, there was one $25 expense that was the only thing reported on it. Personally, I probably would not even record that or account for it. I would just not even put that on my tax return. And I doubt Donald Trump was going into QuickBooks and entering that $25 expense. So clearly he has some sort of structure set up that is, documenting this information for him. The tax planning to me seemed to be multi-year. So he wasn't just looking at 1 year kind of in a vacuum, but looking several years down, which I think is interesting too, being that the years we were covering were, kind of pre his presidency and then leading up to it and then during his presidency. And so we'll kind of walk through the kind of the changes that we saw during that. And also the Tax Cuts and Jobs Act of 2017, which was kind of his, it really was his tax plan. It really kind of hurt him from a variety of ways. I think maybe there were a couple things that potentially benefited him too, but from his normal stuff on his tax return, it limited some of his pretty large deductions. So we'll kind of give some examples of that. And then just from a high level, and these are kind of related to some of the things, like I said, the strategies that we use too. Being in real estate and the businesses that he was in, a lot of depreciation, a lot of tax credits. He had a lot of foreign income, which is another area that we work in. So he had a fair amount of foreign tax credits related to that as well too. Some of the common themes that we saw. And with that, I'm going to jump into the first year. I have a bunch of notes here, so I'm going to be looking down a lot more than I normally would be. So I'm going to start with 2015, and I'm going to do a little bit more in-depth, and then the years after that will kind of be more about what was different or changed. So 2015, he had $9 million of interest income, which kind of surprised me. At $9 million is quite a bit of interest income.
Yeah, and that was kind of a theme throughout, right?
Yeah.
Fair amount of interest and dividends, which ultimately surprised me, especially seeing where it came from.
Mm-hmm. As Aaron said, he had about $1.7 million in dividend income in 2015. He had about $40 million in capital gains. He had about $7 million losses in the real estate on his personal return. Obviously, there was a lot of other business entities that had real estate related to. And he actually had a net operating loss carryover of $105 million from previous 2015. So I didn't see what year that was created in, but some year prior to 2015, he had a net loss on his tax return of $105 million or more. And that you get to carry forward. And he actually used, I think, about 30 or 40 million of that in 2015 to wipe out. Essentially, what it came down to was that capital gain that I just mentioned. So, again, it seems like this was planned ahead of time, and they kind of planned on how they were going to utilize some of this stuff. So, itemized deductions. He had $8 million in itemized deductions. $6 million in state taxes. Most of that was to the state of New York, which was common every year. It was about $5 or $6 million. He paid $573,000 for his tax preparation. So he maybe would be our biggest client.
Just maybe.
Maybe. And then he actually had a $20 million charitable donation for a conservation easement, which I know was kind of all the rage back then. It's kind of been... the IRS has cracked down on it since then. I know in the last 3 to 4 years. But that he actually wasn't even able to claim because it was limited by his adjusted gross income. So again, that carried forward, something I'm assuming we'll probably see him use in one of these future returns that we talk about. So he actually had, he was subject to the alternative minimum tax. Then his income was essentially wiped out with an NOL, but because of how he had earned his income, it put him back into this alternative minimum tax, where he had a $2.1 million AMT, but then he had $1.5 million in credits that he was able to use to wipe out most of that. So he did end up paying about $730,000 in taxes, using a lot of rounding on these numbers because there's a lot of big numbers.
It's an interesting thing too as we walk through a little bit is at what point and where do you say what somebody paid in tax? Now I'm probably taking us way down a weird path, so I won't go too far. But Steve will probably talk more in his 3 years, and I'll talk about it in a little mine. But the tax before credits for many of the years was actually, 18 going into 1920. There's some different things happening, but from on my end, his tax was actually very high, $9 million. It's taking advantage of a lot of different credits and items that allowed him to have lower tax. But what's his actual tax? And some of that kind of comes up in the debate when I hear people say, so and so didn't pay any tax. But anyway, sorry.
So that was kind of a high level summary of the return. So I'm going to dig into some of the specifics. So businesses. So Schedule C's. So this is a business that essentially it was either him and or his wife were the only owners and ran these businesses. There were 27 of those on his tax return. I think that's the most I've ever seen. Those ranged to the industries were aviation. He had a few speaking engagements, multiple real estate management, golf, an ice skating rink, a couple restaurants. And a lot of these were actually very small, like a couple $100 or maybe a couple $1,000 in revenue. And most of them were, not huge money makers or huge losers, but there were a couple of them. The restaurant actually lost $368,000. Some of that was because of depreciation. Aviation, he had 2 Schedule C's related to aviation. One of them looked like it was probably new, and he actually had more depreciation than he had revenue. So I'm assuming it was probably the first year he had bought a bunch of planes and equipment, and so he was depreciating that, and obviously using as much of that as he could because, as I talked about earlier, he had income that he was essentially trying to get rid of, right, or wipe out with some of this depreciation. And also in the aviation, he had about $1.5 million of expenses added back, meaning he didn't claim those expenses. And that was related to personal use and like lavish or extravagant expenses. So the IRS doesn't allow deductions related to those types of expenses. So he did have 1.5 million of that added back. Again, I'm assuming personal use probably of planes while he's flying for personal use. He did pay about $5.8 million in wages on all of these. Most of that was for the restaurants, which he also got an employer tip credit. I know that was across all of the years. Wasn't too significant in grand scheme of things, but
yeah, I think some of it was tough in seeing in mind. But the biggest year where he actually had a potential large tax bill, it was about $300,000. There's a lot. The tough part with analyzing a lot of this, there's a lot of carryover information. And these bigger returns that we see, we run into the same issue where the history of the years can really play an impact on a current year tax return.
Yeah. On this return, he had 5 rentals on his personal return, so that personally it wasn't in a different business entity. 14 royalty statements, so he was receiving royalties from 14 different entities, if you will. And then K1s, so other S-corps partnerships that he was, a part owner in, or maybe all owner in. He had about 300 or more of them. I stopped counting when I got to like 250 because there were several more pages of them.
He's lying. That's high. That's where Stevens is.
And you estimated 400 and something?
Yeah, I just was counting per page and how many pages of this list, and it ended up, it was like 438 based on an estimation. It was a lot. I don't see a whole lot of returns with 400 some K1s.
No. And the net of all of those, so he had $43 million in passive income, $26 million in passive losses, $27 million in non-passive income, and $53 million in non-passive losses. So if you look at that, it's like he was trying to wipe all of that income out with the losses. And specifically some of those, Mar-a-Lago showed $4 million of income, Trump Corp, $5 million in income.
And these were net income, right?
Net income, yes, net income. And this is his share of the net income. So if it's a partnership or S-corp and he only owns a portion of it, whatever his share of it, these are the numbers that I'm giving. Trump International Golf was $1 million. He had a few several 10 maybe golf courses. They were every year they seem to produce a net of $1 to $2 million. I would say is his portion. Every once in a while, one would show a loss. I would assume that was probably a year where they did a redevelopment or had some large capital expenses related to it. Trump Productions made $5 million in income. He had a hotel in Hawaii, $2.3 million. And they had a lot of losses in what looked like were mainly development entities, so where he was developing real estate. And looking, kind of tracking some of that across year to year, you would see, this one might show $7-8 million loss one year, and then it shows positive income the future years, which again, might be the first year that project went into service. He took a lot of depreciation, and then he ended up having positive income on the returns going forward for that. W-2s. He actually had 12 W-2s. All of them were really small. Like I think his total wages were like $4,000 through 12 W-2s. And they were from entities like 20th Century Fox, Universal Studios, Warner Brothers Studios, Paramount, Walt Disney. Again, some of these were like tens of dollars. Some of them were a couple $100. We were kind of talking, it must be how he was kind of paid out on some royalty type of things or how contracts worked. Foreign tax credit. So he claimed foreign tax credit every year. He had a lot of foreign business dealings. I counted 22 different countries that he reported foreign income to. Some of these he had multiple sources of income, so there are multiple schedules for. And then he had a general business credit. So he had, it looked like it was 2014 was when this was created, but he had $15 million credit carryover. It's an investment credit carryover, business investment credit from oil and gas, which was kind of similar to conservation easement, was kind of all the rage back then. I think you actually had a little more experience in working with those than I did, but that's not uncommon, I would say. I know you had clients who.
Yeah, it's used really quickly to wipe out income in a certain year based on an investment, and some of them got 80 to 90% deduction in your investment in the first year, along with the credit. So they were slick uses of tax planning and tax strategy.
So he had a couple of foreign bank accounts. Foreign bank account reporting, there's 2 thresholds. He didn't meet the threshold after have to prepare an FBAR, which he met the lower threshold, so he just had to report on the main part of his tax return, if you will, the balances, account numbers, and those types of things. And like I said, it was just a couple of them. And then he also had some PFICs, passive foreign investment companies that he had to report as well too. And then there was a lot of reporting related to the foreign income that was on there. So it's 2015. Anything? No? Good?
Not anything major. I mean, sounds like a really big tax return.
Yeah. 574 pages, I think it was. Yeah. And I looked through all of them. So a lot of it I got to scroll relatively fast. So, all right, 2016. So we had wages of $978. Again, that was a lot of those same W-2s that I had mentioned from 2015. His NOL carryover was still $73 million, so he used 2032 from 2015. Business income on those Schedule Cs. So he didn't have 27 of them. I didn't count. He probably, I'd say, roughly had 20 of them that year. There were no large losses on any of them, and he actually combined had $9 million. One of them was a real estate development entity that had $8 million in income that year. He had a $11 million capital gain, which I actually saw was Trump Park Avenue was a condo that he sold for $14 million. So again, this tells me his basis was only $3 million in it. So it was probably something he bought for relatively low amount compared to what he sold it for, and or depreciated a fair amount of his basis in there too. His real estate partnerships, S-corps, he showed a total $16 million loss. Again, kind of netted out the passive and the non-passive. Again, it almost seems like he used that $16 million loss to offset capital gain and some of the Schedule C income. Those entities, Mar-a-Lago had almost $8 million in net income. he had a lot of income from the development projects, which, like I said, the year before he had a lot of loss in. So, in theory, that makes a lot of sense on how that would go. Trump Corporation had a $7 million loss. I didn't get a chance to go into that return and see, why it showed $5 million in income the year before and $7 million in losses the next year. Again, I would assume it was some sort of a purchase. He actually made a lot of money in Las Vegas that year, $13 million in sales and marketing. And there was another hotel, I can't remember what it was that, I didn't write it down, where he made another, $3 to $4 million. And then Trump Entrepreneurship Initiative, I think it was called, also known as Trump University, which I think we all know failed. And that was the year he got to take the $9 million loss for the failing of Trump University. So that led to, obviously, some of those losses. And there was another one, which I'll bring up here in the future, but the Trump Old Post Office, it was called, and it's actually a hotel. I think it was a post office in Washington, D.C., that was technically owned by the federal government. I think it was 2012. He earned the right to buy a lease on the property, and he redeveloped it and turned it into a hotel. And so in 2016, he incurred quite a bit of expenses related to the redevelopment of it. $23 million loss that he showed on it. And looking at this, I actually saw he sold it last year. He sold the rights to it, to the lease, for $375 million in 2022. So
we should look at that return.
2022?
Yeah, you think he'll give that one up?
We can ask.
Yeah.
I bet you'll get sued. Itemized deductions. He had $4.2 million state taxes. He had carryover charitable contribution, which I kind of talked about from that easement the year before. And he paid $1.3 million in tax preparation fees. That would probably make him our biggest client.
That would sneak him into the category.
So you think our fees are high, huh?
Whoa, who said our fees were high?
I'm just joking. All right. So he did. Again, he had alternative minimum tax of 2.3. So essentially, he used the NOL and all these other losses that he had from that year to wipe out all of the other income. But because of how he had the income that he actually had, brought him back into this alternative minimum tax. He owed about $2.3 million of that. He actually was able to offset all of that with tax credits that year, so he didn't owe anything at the end of the year. Except he actually did owe a little bit he paid self-employment tax and some additional Medicare tax. So he actually did owe like $600,000 that year. So it's 2016 in a nutshell. So again, 2015 was pre-presidency. 2016 was when he was running, right? Now we're getting into 2017, which is his first year of presidency. So his wages were $373,000. They went up significantly. It was the new job that he took. And so all of that, actually, there was I think there was.
So he doesn't get quite the 400 because he doesn't start till like 20 some days into.
Well, I was wondering that, or did he max out his 401k?
Could have, but his ones for 18, 19, 20 were all, and so he could have put some money in, but they were like 393.
Oh, really?
393, 229. They were all right about the exact same number.
Oh, yeah, that is interesting. Huh. It would make sense though. He didn't start until like the 21st or whatever, right?
Yeah, you can't get
paid for a full year. Yeah. It's interesting. That year was down from the roughly $8 million that were the first 2 years to only $6.7 million. And then business income on Schedule C. So I said in 2015 he had 27 Schedule Cs. He only had 6 in 2017, which he was probably busy doing some other things that year, not able to run as many businesses and do as many speaking engagements and managing real estate activities and things like that. So
he was playing too much golf.
possibly. The net of all of those entities that year was $1.4 million. I don't think any of them had losses. It was all, you could tell there was just much less going on that year. He also had $28 million in discharge of debt. which I know you saw in some years too, and it looked like he was able to spread some of that out using some of the tax laws as well too. He had a $7.5 million capital gain. He only had 2 rental properties that year. Not very many of the royalties coming through anymore either, so that activity dropped significantly.
All this kind of stuff starts at 17 because the 18, 19, 20 were similar.
Yeah,
the 5 or 6 Schedule C's, the 3 rental/royalties.
That's why when I started looking into it and I offered to take those first 3 years. Yeah, I realized that those were the much more longer ones to have to look through. So you're welcome.
We put our smartest person on it.
Thanks. All right, his other partnerships, S corps, had a net loss of $16 million. Again, he kind of wiped out all that other income that he had with it. Mar-a-Lago, $6.7 million. He had some development income. Trump Corp showed another loss of 11. DJT Holdings, which I'm sure you probably saw. It seems like Trump Corp and DJT Holdings, and then he's got a lot of kind of entities spun off of those two.
1, 2, and 3.
Yeah, and then DJT Holdings, Real Estate Hawaii, and so it looks like he spins a lot of these entities off of those two. That one had a $20 million loss also. Again, a lot of this netting of passive income losses and non-passive income and losses, ultimately resulting in the just under $17 million loss. Itemized deductions. So he had $4 million in state taxes, $1.8 million in cash gifts. Most of that, there was like $1.2 million where it just said like other cash gifts. So I didn't get to see where it went. And he also had Section 212 expenses of $4 million. So guessing you don't know what Section 212 is.
No, I know it's a highway.
I had to search
right around where we are. Here.
I had to search it up. So it's preservation of income, which like I knew was used to be able to take that as a deduction. So, if you're, paying attorneys or paying fees to try and preserve income, or if you're audited and then you're trying to, save your refund or things like that, those expenses are deductible. I did note he didn't pay any tax preparation fees that year, or he didn't claim any. So he went from 1.4 million to 0, which I thought was interesting.
TCJ would have been voted on that year, but wouldn't it hit?
Yeah. So this was the last year of the previous rules. Yeah.
So miscellaneous itemized deductions should have been there.
Right, which gets into kind of what I was saying. A lot of these Tax Cuts and Jobs Act changes that he really implemented hurt him. I mean, they capped the state and local taxes at $10,000. I mean, he was paying $4 or $5, $6 million every year, and so essentially all of that just went away. And then also tax preparation fees. I mean, I don't.
You think he does the PTE now?
Probably.
Yeah.
I mean, I don't know. There's probably not a whole lot of people that pay $1.4 million to have their tax return prepared. So that went away. These other expenses that he had related to preservation of income and things like that all went away too. Based on his, I'm assuming he's still itemized based on his interest expense, mortgage interest expense. Yeah.
Yeah, he still was in the $1 million itemized deduction category.
Yeah, it looked like his mortgage interest was about $1 million a year. Yeah.
And that's with it being reduced.
Yeah. And then that year he had a large credit. And again, it goes back to that old post office that he turned into a hotel. It was a certified historic structure. And so that year he generated $1.5 million credit. I think in total he generated...
You're saying it was some insane number.
Was it like 400 or...
Yeah, like it carried over to 18. It showed that there was 30 million available. But he didn't use that. We'll go through that.
40 million. It was 40 million. Which makes sense because the credit was 20% of your basis after the improvements are made.
Okay.
And this credit has to be signed off and approved on the front end and the back end by the National Park Service, which was kind of news to me. But like this credit, when looking at it, I looked at it, I related it to the solar credits that we've done some. on, where essentially you get 20% of the basis of the property, either that you improve or put into service. So he utilized that. Interesting, the Tax Cuts and Jobs Act changed this credit, and instead of being able to take the credit all in year one, you had to spread it out over 5 years, which I was like, well, why did he do that? Because he didn't even take it in the first year anyways, because he didn't need it.
Mm-hmm.
So it just carried forward anyways for him. So it wasn't like he was like, haha, I did this, now I'm going to screw you guys all over.
Yeah.
Because he didn't use it anyways. Like, so I was like, well, did he, in going through the process, was he like, well, this, you shouldn't be able to take this all in year one. This should have to be spread out. I don't know. It was a little bit of speculation on my part, but
maybe.
Interesting. Yeah. So, again, very similar. He ended up, he did owe some AMT again and related to self-employment tax he owed. But he actually made, I think it was $7.5 million estimated payment that year, which resulted in about a $4 million refund, which he applied to 2018, which, as I was looking, I'm like, oh, that makes me think he's probably going to think he owes tax in 2018. So, take it away.
Yeah, I mean, kind of building from that, it's very interesting to see how he did estimated payments throughout the years. I won't get too much into that because while it's interesting, it almost seems weird because he had very high estimated payments. Some of it applied, but didn't end up owing that much tax in really any of the years. I guess it depends on who you're asking. Still a lot of tax, it seems like. But, yeah, kind of looking at 18, 19, and 20, I won't get in too much of the weeds because I think we'll use a lot of the back end of this to talk about kind of the different strategies that we see in the tax returns, how we try and incorporate some of them, if not kind of the general theory of all of it, into what we do, and kind of just more of that understanding that when you get to any type of, no matter what your income is, there's a cost benefit to how much you're wanting to put into maximizing the strategy to hopefully get a tax outcome that you're happy with and are comfortable with. And I think that's a lot of what we see in some of the returns. 18, 19, and 20 aren't much different. W-2 obviously goes up. Roughly $400K, I think we talked about is $393 and change. The interest, dividends, roughly stay about the same. They're in that $9 to $11, $9 to $12 million range every year. His capital gain, one thing that I thought was interesting in 2018, about $22 million. In 19, $9.3 million. In 2020, $0. Which seemed kind of surprising. Could be a combination of offsets and just bigger deals happening in 18 and 19. Schedule C, like Steve talked about, really almost went away. In 2018, still had a fair amount of loss of, but at his levels, $430,000 isn't that big. And most of it was related to aviation and like $152,000 depreciation deduction on that, along with a fair amount of, it was like $80,000 in repairs and maintenance. So about half that loss was all in the aviation, and then a little bit spread out through the other 4 or 5 Schedule Cs. The biggest thing that I noticed was kind of the consistent but somewhat ever-changing where the losses were in the flow-through entities, the partnerships and the S-corps. But it also remained relatively consistent, large losses. And I think if that was one of the areas, if we spent more time on it, maybe that's round 2 of kind of looking into these, is how is he consistently generating such large losses in these, and how's he doing it while maintaining cash flow? Because that's one of the biggest things I think we look at for our clients is how do we invest in things? How do we save tax money while also generating cash flow rather than buying assets that don't generate cash flow and actually literally depreciate over time in value? But yeah, so those remain relatively consistent. $12 million loss these are all rough rounded numbers. $12 million loss in 2018, 16 and a half in 2019, and about 15 and a half in 2020. There were some interesting other income items in 2018. Actually, just one. Really, it was related to a tax provision on cancellation of debt and how that debt was structured. And you could essentially, rather than taking it in the year the debt was canceled, was able to push it out over 5 years. Had $28 million in income, but was able to use his NOL kind of from even before 15, from what we could see. Was able to write off most of that with a $23 million NOL. So just kind of looking at 18, I know we've kind of talked about them all together, but 18, looking from an adjusted gross income, so before any of the itemized deductions and things like that, his income was $24 million, even with those large losses included in there. And so kind of answering the question where I think one of the reasons people wanted to see tax returns, here's a guy, I make this much money on this, on that, and did you really make that much money? And so it's interesting to see, adjusted gross income of 25 million. Tax on that was roughly 9 million. But what he had is a lot of credits carried forward. So he had, in the current year, foreign tax credits of about 1.2, 1.3. And then he had business carryover credits from some of the items Steve was talking about, and was able to use about 7 million of that to wipe his tax down to about 2 million. And then and so one of the times you hear a lot of people talk about the refunds that he gets in the year. So in 2018, he had like a almost $10 million refund, but it's because he had over roughly $12 million in either applied payments or estimated payments. And he goes on to roll these refunds over, so that the $9 million in refund that he had for 2018 went right into 2019. And applied.
Meaning he didn't take the cash as a refund.
He didn't take the cash as a refund.
He turned that into a payment on the next year.
Yeah, and one of the things we talk about. Yeah, one of the things we talk about with our clients is let's not give the government any free loans. Well, here's a $10 million loan. So, in theory. And so some of the ways that he still ran into tax with some of the large credits. He had AMT in 2018, which was in theory harder to hit, but had AMT of about 4 million. Was able to use some of the credits against that. Also, some other things that we don't always hear about is self-employment tax. He had a fair amount of $110,000, but then also the additional Medicare and net investment tax that came as a result of previous laws from the previous president. But so he did have tax related to that as well. Yeah, and then one of the other things that was on the campaign trail always seemed to question. He talked about, I'm one of the most charitable people. And a lot of people mentioned, I think 2020 will show that he didn't have any itemized deductions. I'll tell you why when we get there. But in 2018 and 2019, had roughly $500,000 in charitable contributions. Not necessarily sure, didn't see the breakdown of, well, is that his salary going somewhere, and then had $100,000 on top of that.
Well, I think you're referring to, because he had said that he would donate his salary.
Donate his salary, yep.
And we were talking about this a little bit earlier today, and I will say, just because it's not on the tax return doesn't mean he donated it, right? And it's possible.
Doesn't mean he didn't donate it.
Correct. Thanks.
Okay.
Right. He could have donated to an entity that you're not allowed to take a tax deduction for, right? So. Mm-hmm. Sure, the media wants to jump to conclusions on it. Sure, it's certainly possible he didn't, right? For whatever reason. But I would say, from looking at the numbers that I saw, $400,000 to him isn't really that big of a thing, especially when he can take a tax deduction for it. Yeah, I think it would be awfully surprising to shout that one out and then not do it. Yeah.
And we'll maybe talk about that a little bit in the standpoint of some of the things that we see doing here are going to lead naturally to being much more likely that your return gets audited, and we'll talk about our theories on
Right.
kind of that concept. 2019, from an income standpoint, very similar to 2018. Biggest difference there is the other income related to the cancellation of debt was over for him, and the capital gain went from 22 million down to 9. So a pretty significant swing. His adjusted gross income for that year was only about 4.5. Tax was 558, so quite a bit lower than what we've seen. He had tax credits of 425, so his real tax got to add in some self-employment and pieces like that. Ended up being 460, so the credits weren't able to wipe out on the self-employment portion and some of the other tax. But then again, it's going to show a tax refund of about $10.5 million, even though there is obviously some tax paid there, and depending on your argument on tax credits, and more tax than zero was paid.
More than you or I probably paid.
I hope so. We did a lot of things that hopefully we didn't pay much either. But 2020, also very similar. The capital gain showed zero there, so that was the biggest change. And from that standpoint, adjusted gross income, he actually showed an overall loss for the year. Still did have some self-employment tax and other taxes, so still paid $272,000, even though it said he lost $4.8 million overall on the year. Still some tax paid. And
Yeah.
That's kind of what I got
Yeah.
on the 18 through 20. Just a little less activity. Maybe it was busy. Who knows? Running the country's probably a big deal.
Yeah,
Never
2020.
tried.
I mean, the capital gain's interesting too, right? Because that was the first year of the COVID pandemic, and the first several months were a lot of unknown, and he was probably a little busy trying to do all that.
That's
and,
right.
And then real estate and the market in general kind of took off, and so if I'm him, maybe I continue to hold those assets. So yeah, it'd be interesting to see 2021. 2022. I don't think we're going to get them.
I think it'd be pretty interesting to see any year.
Right.
But yeah, I think that's kind of our kind of conversation of what we're seeing, what's on the returns. I think, as we said, no defense of the individual, but just a discussion about tax and tax planning and strategy. Really, I think when we originally thought about doing this, the idea was, is this reasonable, right? Like, could you reasonably see somebody getting to the tax returns that Trump had? Could you see somebody having as much income, as many assets that he does, and paying tax at a lower rate than one would normally think? And without analyzing the Trump books, and without having time to go through all the letters of the law on every credit and how he claimed it, it doesn't seem wild to me, knowing the main area that he's in related to real estate. It seems pretty conceivable that he could get his returns to the numbers that he's doing. Mm-hmm. Now, that's not saying that everything's in here is legit, because I don't know, but we use real estate as one of our favorite strategies to help people, especially people that also see real estate as a great avenue.
Yeah, I think one of the things when I saw that this was released, I can't remember what media outlet it was, but the headline was like, Trump's tax returns show that his business dealings aren't as profitable as he claimed, right? Well, it's understanding, well, that's from a tax perspective, right? And we're dealing with these depreciation and these things that are probably a lot different than what he made from a cash standpoint, right? Mm-hmm. As I was going through them, I had one client specifically that I was kind of thinking about, and we've used the charitable contribution and making large charitable contributions and rolling them over. We've used large depreciation in the past with them, creating an NOL for future. And this client owns roughly 100 rental properties in Minnesota. They are very charitable people, and 1 year we filed a tax return that showed a $2.1 million capital gain and then a $3 million loss from their business, which we created with depreciation and a cost segregation study. This was in 2019. That return was just audited, passed the audit. And I would never say that these people are not successful. They're, like I said, they're also very giving. They in the 1 year they donated one of their properties to a charity. So I saw a lot of similarities in what the returns looked like with what this client's returns will often look like. That year we created that $900,000 roughly NOL that they've used the last couple of years too. So it wasn't all news to us, I would say, and how he got some of the credits I think were interesting. I didn't know that he would have had the NOL from before, but yeah, it just seemed like there was a lot of thought that went into a lot of this as well too. So I'm assuming, like I said, a lot of work. He had clearly paid a lot of money for tax preparation the 2 years that we have data for. I'm sure he paid a lot of other professionals for it as well too. I'm sure these weren't schmucks that he was paying, So yeah. Any other takeaways that you got?
I don't think so.
Otherwise, it's probably getting a little long.
Yeah. Is anybody still on there?
If you're still here.
Because this isn't live, dum-dum.
So if you're here this long, appreciate it. Hopefully it was good. Long, but good. If you liked it, share it, like it, push the buttons saying you like it.
Watch it twice.
Tell your friends. I actually had a friend of mine ask me on New Year's about, he's like, hey, did you get to review the returns? He was joking, and I was like, actually, we were talking about doing a YouTube video. So then I saw him a couple days later, and I told him we were going to do this. So we'll have one person watching.
We'll probably watch it just to review.
Sure, yeah. 3, 4 if Tran does.
Perfect.
All right.
Thanks a lot. Yeah, like and share. Check out our socials.
All right.
Everything we say. I feel like we've said a lot. That's it. Cool.
Thanks.
See ya.